Hello, everyone. Welcome to the weekly roundup. Today we will cover growth, interest rates, and earnings releases. Hello, Ben.
Hey, Eva.
I've got a different view.
I know, looks great.
I found a good spot.
Excellent. Not echoey. It's good.
Yeah.
Yeah.
Okay, let's get into it. It's been an interesting week. The US economy contracted in the first quarter, and this is the first time in 3 years. But the Federal Reserve still decided to hold interest rates steady. Was this outcome expected, and what can we anticipate for future meetings?
Yeah, so I think we've certainly flip-flopped on interest rates this year. And so I think the market definitely priced in that they weren't going to do anything. And yesterday we had another volatile session kind of after they announced, and market was up coming into the meeting. Rate announcement, not a lot of action throughout the press conference, which is half an hour later for about an hour. Markets kind of turned red and then finished up by the end of the session. So, I think it was generally expected that they were going to hold. We still are pricing in cuts this year. So I think presently right now our economics team is saying 3 cuts, so 75 basis points by the end of the year. And so that's certainly going to be contingent on your first point, which was the economy contracted. So if this continues, I think you could maybe see some of those rate cuts pulled forward. Um, you know, their objective continues to be controlling inflation and unemployment really seems to be their key focus, right? So unemployment was so jobless claims were in line this week, so neutral. Unemployment really has been fairly stable, so I think that's what is a big part of what kept them on the sidelines. We've seen a slight tick up in wage inflation here, but not enough, I think, really to have a material impact yet. But I think because markets bounced back, spreads came in, a number of these things that caused the Fed concern a month ago aren't the case today. So market was generally expecting nothing to happen. And after the press conference, the view continues to be that rates come down in the US this year still.
Okay. This week also featured key trade-related meetings. We had Carney and Trump, the US and the UK, US and China. What were the main takeaways from these meetings?
I think main takeaway is that Trump really hasn't changed his stance much. I think it looks like the UK and the US have some kind of trade agreement. I haven't had enough details to really get comfortable around what that looks like, but the market's taking it as a positive today. We got broad markets up kind of around the world. China, US, I think still left and probably continues to be the biggest question as to where we go from here. There are high-level meetings happening between China and the US and Switzerland this upcoming weekend. So that'll be something important to watch, see if there's anything interesting that comes out of that. But as for the meeting between Carney and Trump, that was an interesting meeting. And I watched it, and I'm sure you watched it as well. But, I think the view is still that there's a challenging relationship between Canada and the US. And so I looked at some of these stats just to really try to get a concept around, how material it is for both countries. And we're the largest exporter to the US. And the biggest export we have is oil. So presently, we export 4 million barrels a day. The US produces 18 million and consumes 18 million. So they need to import in order to really meet their supply demand. So, that's a big one. So if you look at, what is one of the key risks to both countries is obviously we need to continue to export to generate revenue. But in the US, they also need to import our oil, and their refineries are built to process heavy crude that comes from Canada. It gets blended into gasoline, which is what keeps their country and economy going. So it's really a key piece that I think will continue to play a role here. The other one I know that we've talked about a bit, and they didn't talk about too much in the meeting, was just the softwood lumber. And so, the U.S. Housing starts has been pretty slow, so it hasn't been a big issue that there's been pressure on the U.S. home builders, but they import something like 60 to 70% of their softwood lumber from Canada. And so if that gets put under pressure and gets, increasingly taxed and tariffed, that has a negative drag on U.S. housing. U.S. housing is a material part of the consumption machine that the U.S. has. So, I think that the meeting itself went pretty well. I do think that Carney stated a lot of facts and information that refuted some of Trump's statements. So generally, I think it went well. I do think that he seems much more keen to work with them. Actually, he said some nice things. Trump said some nice things about Carney. And so I'd say what my hope is continuing to be is that Carney's going to do a good job at working behind the scenes, that they'll put some deals together and some things in place. I think tariffs continue no matter what. It's just a matter of what that final number is, what's it on, and I think the market wants certainty more than it wants to know that that number has to be 0 or 10 or 12 or whatever it is. They just want certainty, and then you can plan around how to move forward from there.
For sure. A couple more earnings releases this week from the tech giants to Disney, Uber, Starbucks. Any notable highlights?
Yeah, I mean Disney's results were quite strong, and the stock jumped to about 10% yesterday, up another 5% today. So that's interesting. Certainly, Disney's a pretty good litmus test for the health of the consumer. So that was an interesting call out. Google had some mixed results. Their search engine's starting to lose traction, which makes a lot of sense with the AI revolution.
Yeah.
And so that will be interesting to watch because such a big portion of the revenue comes from ad sales. So they have integrated their Gemini into the search engine, which will probably help them kind of maintain that searchability feature where they didn't initially have it, and ChatGPT was taking some of their attention. So that'll be an interesting place to watch as well.
Yeah. Let's see the charts.
All right. Just bear with me for one moment. Oh, I thought they were right there, but took a moment. As you know, it's May 8th. We're recording May 8th around 1 o'clock. Anything that happens after this, we certainly can't comment on. And yeah, so there's a number of things. The one piece which I didn't cover in here in these charts is just sentiment. I thought this was a great chart, but we can talk about sentiment at the end. I put this out in the daily. If you see, just around the travelers are shunning the U.S., which is and may appear not that significant, is quite material. So you've seen a very steep fall off in monthly visits to the US. And, as our economics team points out here, steepest monthly decline outside of pandemic lockdowns since 2001. So this is material. And the US is a consumption based economy. And so you need visitors into a number of places in the US, particularly in Florida, California, the hot vacation spots. And so travelers stop traveling there. This will have a material impact on GDP. So we'll continue to watch this. I haven't put this up in a while, but this we get on a weekly basis. It's the economic financial indicators. This is based on both financials, soft data, and hard data, and it's indicators 3 months before recession. So pretty good from a perspective of trying to think about asset allocation and such. If we think that we're starting to see an uptick in some of these indicators, then you may want to think about the portfolio positioning in the event that we slow down faster than expected. So if we look on this last reading, the one standout here is oil prices are down 32%. copper price is down 13, which isn't quite into the red bucket yet, but certainly continues to slow there. So that'll be interesting to pay attention to. US dollar is up slightly and the yield curve. So this is the 10-year minus the three months. So extremely flat, almost inverted. So moving back towards that level. And then how far the market was down. It says down 8%. This came out earlier this week, probably down about 5 now year to date. Then the consumer sentiment, this is the Michigan data that they look at. So consumer sentiment continues to fall. I think this will be a key piece to watch here. Markets have recovered a bit. The sentiment pick up? Certainly it has on the equity side, but does it pick up on the consumer side? The other one certainly is ISM services. So ISM services, anything below 50 tends to be contractionary. Same with ISM manufacturing. So we're starting to see some contractionary data. CEO confidence is also worth paying attention to. And then on the hard data side of things, so unemployment claims at 7%, so isn't screaming red yet, but certainly is yellow. We need to pay attention to this. And as I mentioned, building permits continue to be on the negative side of things. So great chart to pay attention to, just thinking about what could potentially happen. And as we start to look ahead, these are 3 things that will come up next week, which is housing starts, import price index, and consumer sentiment. So these will be great things to watch next week on Thursday. So we can have a look and see what that looks like as we go ahead. I'd say one of the interesting pieces that came out of the research, Shiva, which you asked about, any interesting company pieces that are worth paying attention to. The one area within Amazon's earnings, which I thought was interesting, was they're talking about their satellite program to potentially compete against Starlink, or as be a competitor at least to Starlink, is to start to launch some satellites. And so their target is to launch 32 satellites, expected to roll out this year. And then be in a position to potentially compete from a satellite broadband against SpaceX. And so as you think about Amazon, how it's evolved as a book selling business into the massive consumer-based business that it is, something around 78-79% of their revenue still comes from their online, but they are diversifying their business, and the launch of their satellite project, I think, is interesting and important to watch and see how that plays out. But it could change the dynamic of the Amazon business, and something continue to pay attention to. Last piece, these opinions expressed do not necessarily reflect those of NBF. I prepared this report with my best judgment and professional experience. As always, any questions, please consult myself or your financial advisor, and they're happy to provide comments around their views and the risks associated with anything that we discussed today.
Thank you, Ben. I know you already gave us some guidance for next week, but in terms of trading sentiments and volatility, is there anything we should watch out for next week?
Yeah, so I think those are probably key points, because if we look back, I was looking back at 1 month ago today, and if you can imagine, 1 month ago today, the S&P was down 5%. On a single day. So a month ago, we had super negative sentiment in the markets. The fear and greed index had got down to a 3 1 month ago. Now we're creeping back up into the 60-70 range, which has moved from extreme fear to, we're not quite at extreme greed, but we're certainly tilting towards that way. So we'll continue to watch that and what we do from here. But that sentiment has swung very quickly in the 1 month time frame, and so I'd be watching that quite closely and seeing what, if anything, we need to do from this point.
Yeah, great. Thank you for listening, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeat, as always, will be in the caption of this video. For our clients, please reach out to me if you have questions or if you'd like to book a review meeting with Ben. Thank you, everyone, and have a good weekend after you get through Friday. Bye.
Thanks. Take care. Bye.